Welcome to RICS Monitor, CP's quarterly podcast series that tracks sentiment toward real estate across the globe. I'm Senior Editor Laura Valean, and you're listening to our final episode of the year. 2025 was a year of mixed sentiment across global commercial real estate, marked by sharp contrasts between world regions. So, what will 2026 bring? Which sectors are best positioned to weather economic and geopolitical uncertainty? Stay tuned. We'll explore these questions and more in my conversation with Tarrant Parsons, Head of Market Analytics at the Royal Institution of Chartered Surveyors in London. Happy to speak with you again, Tarrant.
Hi, Laura. Good to speak to you.
The latest RICS report suggests that this year is still a year of mixed sentiment across global commercial real estate. How would you summarize the overall mood in the commercial real estate market as we get closer to the end of the year?
Yeah, I think globally, commercial real estate conditions remain uneven. So some regions are showing kind of stronger growth, others are still facing quite considerable headwinds. In fairness, if you look at the aggregate level picture, I think sentiment has improved slightly compared with earlier in the year, but of course, conditions remain fragile in many locations. So if you look at the stronger end, North America, parts of the Middle East, they are seeing firmer demand, but it's some of the larger European markets and especially China that continue to struggle. So overall, I think the tone is relatively cautious still, pockets of optimism, but I think uncertainty around trade, interest rates, geopolitics continue to cloud the outlook as they have done most of the year.
And one of the main takeaways from the latest survey is that widening gap between markets. There's optimism in regions like India or Spain and the UAE, and it's contrasting with more subdued conditions in China, in France, and in Germany, those large countries you mentioned earlier. What's driving these regional divergences?
Yeah, I think the regional divergences that come through really reflect differences in macroeconomic momentum or economic growth momentum, also the policy environment and structural headwinds as well. So I think in the more optimistic camps, you've got economic growth that's resilient. You've seen some structural reforms that have spurred investment. I think Spain and Portugal are a good example there. So they've also benefited from falling inflation, quite robust tourism, and as mentioned, reforms around labour market. And so this is all reflected in their headline sentiment readings being the strongest across Europe. India really experiencing rapid digitalisation and some pro-business reforms as well. I think the IMF expects GDP growth in India to come in around 6.5%, 7% in 2025, and that's of course well above the global average. I'd say the UAE's strength stems from its population growth. You've got some business-friendly visa reforms and attempts to diversify beyond oil. So all of those markets display very positive views towards the near-term outlook for commercial real estate. In contrast, China's property sector is really weighed down by an overhang of debt. You've seen falling sales and demographic headwinds, whereas those, especially UAE, is benefiting from trends moving in the other direction. So I think France is also struggling with sluggish economic growth, but a lot of political uncertainty as well. So that's what's coming through.
Mhm. And meanwhile, investment sentiment seems to be stabilizing or even improving in some markets, particularly in North America and parts of APAC. What's behind this cautious optimism among investors?
Yeah, in the US and Canada, I think lending conditions have improved gradually throughout much of this year, and on the back of that, investor activity is picking up to a certain degree. I think that's particularly visible when it comes to high quality office and industrial assets. In Asia Pacific, away from China, I think investors are also encouraged by a more accommodating interest rate environment in some key markets such as Japan. I would also highlight Australia as seeing something of a
Mhm.
recovery, and even in the weaker markets, there are opportunities in more kind of, for the time being, at least niche sectors like data centers or student housing. So the optimism is a bit measured. It's driven by improving fundamentals in certain segments. So not a full-scale recovery, but certain aspects of the backdrop in Asia Pacific are improving.
Mhm. Speaking of recoveries and improving conditions. The results for both North America and Europe highlight improving credit conditions. How significant is this shift for unlocking stalled projects or refinancing opportunities?
Yeah, better lending conditions have been one of the brighter kind of features of the market feedback. I already mentioned North America, but also across Europe so far this year. So I think after a long period, uh, kind of between 2022, 2023, where credit availability was kind of tightening, banks are gradually increasing lending, especially to well-capitalized borrowers. And funding does remain selective. Secondary assets or economies showing weaker growth, they aren't seeing the same level of improvement, but the broad trend points to a slow warming up of across credit markets, and that is beginning to feed into stronger investment activity, even if it is patchy. I would say on the development side, so looking at financial conditions across the construction industry, I wouldn't say a huge improvement has emerged as yet. So if you look at our data from the Construction Monitor, credit availability is still reportedly deteriorating across most world regions. So there's a bit of a distinction there between standing property investments and development. But the forward-looking picture for construction lending conditions has turned a little bit more encouraging. So hopefully that will come through, just a bit more delayed, it seems.
When it comes to property values, the latest report mentions concerns about properties being above fair value in areas such as the UAE or the Saudi Arabia area. Are we entering a phase of overheating in select high growth markets?
Evaluations have risen very quickly in parts of the Gulf, and so some survey participants are becoming a little more cautious. I would say, though, that these markets still benefit from a strong population growth, the attempts to diversify away from oil, as I mentioned, and limited high quality or top end supply. I've also seen
Mhm.
policymakers introducing some cooling measures, so stricter lending standards and caps on loan to value ratios, just to prevent speculative bubbles emerging. So that's important. So while I think valuations are quite rich, the market's not considered to be at the top of the cycle as yet. Rather, it's uh, moving from exuberant growth to a more mature phase where price increases do moderate, but the direction of travel is still upwards. What you're likely to see is that growth across secondary tiers of the market falls off more noticeably, but prime assets still retain a reasonably strong outlook.
Mhm. Vacancy rates remain elevated across many regions, especially in secondary office and industrial properties. How are landlords and investors adapting to excess supply?
Yeah, absolutely. You see very strong evidence that vacancy rates have risen considerably in many markets over recent years, particularly, as you say, for older office buildings. Also, I'd put in retail, certain segments of retail as well. Landlords are having to adapt by either kind of upgrading properties or offering incentives, which is what we see a lot, rent-free periods, or repurposing them for new uses where possible. So investors are certainly becoming more selective, so focusing on modern, more sustainable buildings and needing to retrofit older ones in order to meet stricter environmental standards or regulations going forward. I think the overall message is that there is an oversupply of secondary space. That's a bit of a long-term issue, and I think it's going to take significant investment, in some cases, a bit of creativity to solve that.
There's also a clear two-speed story in the office sector across all regions with strong demand for prime, amenity-rich spaces, but persistent weakness in secondary stock. What are the long-term implications of this?
Yeah, that divide between prime and secondary offices, I think for now, if anything, it's kind of widening, so that you have your modern, well-located, energy efficient buildings that are continuing to attract tenants and investors, but the older stock is really struggling, and that's where vacancies are up and rents and values are down. So I think over time that two-speed dynamic will likely accelerate the obsolescence of the poorest quality buildings. I mean, buildings that cannot be easily upgraded, and they may need to be repurposed altogether. So for investors, the office sector is clearly not a homogeneous asset class. You really need to focus on the building quality, the location, and ESG compliance. So those who kind of own prime assets, they should see very solid rental growth, but holders of secondary stock may face prolonged vacancies and capital depreciation unless they find measures to address that.
Meanwhile, alternative asset classes such as data centers and aged care facilities are consistently cited as outperformers across the board. Why do these alternative sectors continue to attract sustained investor confidence?
Yeah, these sectors benefit from very powerful longer term trends that are less tied to economic cycles. So the digital economy is fueling demand for data centers. We've got growing student populations in some areas that are supporting student housing, and then aging demographics really are driving the need for more senior living and more kind of healthcare facilities. And investors just see these sectors as providing quite dependable, inflation-beating income growth and lower offer a lower correlation to the mainstream real estate sectors. I'd also say capital value expectations for those assets remain positive, even in markets where traditional sectors may be still under a bit of pressure. So kind of it's the sustained structural tailwinds that explain why these alternative assets continue to attract such strong attention.
Mhm. As usual, let's take a closer look now at each world region. In the APAC, China continues to drag down regional averages. You mentioned China before. The market is stuck in a downturn in that part of the world. What structural challenges are preventing a turnaround there?
China's property sector really remains weighed down by high debt levels. There's very weak confidence right now and demographic challenges. So many developers are still struggling or struggling with kind of insolvencies. That's leading to some incomplete projects. And I think just demand for commercial and residential properties is subdued, and local governments have limited room, it would appear, to stimulate growth. And kind of the broader structural issues, we've seen slower productivity growth, there's an aging population, that's really difficult to resolve. And I think until confidence returns, China's real estate market's likely to stay in a kind of slow moving adjustment phase.
In the APAC, India stands out. As you said a few minutes ago, this country is a consistent outperformer with expansion across occupier and investment markets. What are the key fundamentals driving India's resilience?
India is really supported by strong economic growth, seen pro-business reforms, and demographically, it's a younger population. It is forecast to be one of the fastest growing large economies over the next decade. You've seen policy measures such as the digital identity system, goods and services tax, an emphasis on manufacturing. All of that has improved productivity, and it helps to explain why occupier investment sentiment is very much positive across all sectors in India. So tenants are expanding in office, industrial, and retail. Investors are particularly bullish on data centers and multifamily housing. I would say India's got still a structural undersupply of grade A space, and so when you couple that with growing demand from technology firms and global corporates, it's all supporting that strong picture for rental and capital value growth.
In the Gulf, we see a contrast between a robust UAE market and a cooling Saudi market. What are the underlying policy and market dynamics shaping these trends?
Yeah, both markets remain active, very solid, but their momentum differs. So the UAE really continues to benefit from the policy environment that has been very successful in attracting foreign investment and foreign workers. And there's evidently strong demand across all sectors. Saudi Arabia, while still expanding, that growth is cooling slightly. It's in part linked as well. So we've seen some rent controls that were introduced recently in Riyadh, and some caps on rents, and there's been slower take up of some of the large development projects with regards to occupier demand. So both markets have been on an incredibly strong run. It just seems that this is now moderating in some segments across Saudi Arabia, while we've yet to see any noticeable slowdown in growth across the UAE.
In Europe, you said earlier that France and Germany remain subdued while Spain and Portugal are the bright spots. Are we witnessing a long-term reordering of European commercial real estate attractiveness, or are these just cyclical differences?
Yeah, well, right now Spain and Portugal are, enjoying a very solid recovery, supported by tourism, lower inflation than many parts of the world, and earlier reforms that have strengthened their economies. So I think the current differences partly reflect where each country is in the cycle. So Spain experienced a very steep downturn after 2008 global financial crisis. Also, the Eurozone sovereign debt crisis as well had a huge impact. But since then, it's restructured banks, and that has been successful in attracting some foreign investment, and it's kind of reaping the benefits of that. Germany and France enjoyed a stronger initial period of post-pandemic recovery, but now they're really facing cyclical headwinds. Um, Although, to be fair, the results across Germany are turning less pessimistic with regard to the outlook across commercial real estate. So I think, given the different nature of these economies, you will see phases of the cycle where the southern European markets outperform, but whether this marks a permanent reordering, I'm not so sure. If economic growth continues to outstrip that of some of the um, the larger nations, then perhaps. But what we've seen in the past is, stronger upturns when times are good, but also sharper pullbacks during tougher conditions.
One last region we need to touch on is the US and Canada, which appear to be moving from stabilization toward recovery, particularly in the prime office and multifamily sectors. How sustainable is this recovery, given policy uncertainty and those tariff pressures?
Yeah, the recovery across the United States and Canada in terms of commercial real estate, particularly in the prime office and multifamily sectors, that is progressing positively for now. But how sustainable that is, obviously, it's very fragile given the macro and political risks. So, in the US, tenant demand has really picked up. On the investment side, credit conditions, as I said, are improving. That's all helping the picture. For Canada, we're seeing a bit of a stabilization. There was something of a blip earlier in the year due to those kind of tariff measures being announced. Um, but more recently, investor interest in quality assets is improving once again. Of course, the backdrop of unpredictable US trade policy has the potential to kind of knock investor confidence and may dampen growth if there's another unfavorable twist that comes through. So while fundamentals do appear to be broadly supportive, that the recovery or the strength hinges on a stable macroeconomic environment. We do need to see further declines in interest rates come through as well, and obviously we want some clarity with regards to trade policy. Without those, I think performance could stall or reverse. So it does remain an area where, yeah, some positivity but a lot of caution still.
There's one topic that several survey respondents mentioned. They referenced AI as being both a disruptor and an opportunity. How is technology reshaping occupier demand and investment patterns in commercial real estate?
Yeah, technology and AI in particular, it's really reshaping how buildings are managed, how they're leased, also how they're valued. I think automation is improving efficiency, reducing some costs as well, but it's changing tenant expectations. So occupiers now want smarter, more flexible spaces, and investors are channeling funds into more kind of tech-enabled buildings. So AI is seen as both a disruptor and an opportunity, as you say. It's driving demand for new asset types, and then also forcing the industry to modernize faster.
Finally, based on all these aspects, what are your expectations for 2026? Which regions and sectors are best positioned to weather ongoing economic and geopolitical uncertainty?
Yeah, I think that the coming year is going to remain uneven, as usually is the case. I think growth should stabilize globally, pick up slightly perhaps, but the market's going to continue to move at different speeds, going to have outperformance, I would imagine, is going to continue across those economies with better momentum. So India, Spain, and parts of the Middle East that we've gone through, I suspect they will all stay relatively resilient. North America is expected to progress steadily, although it's already experienced stronger conditions than markets such as Europe. So, whether that will continue, it remains to be seen. But I think, France and China, those type of areas, I think they'll need a little bit more time to regain traction. Sector-wise, data centers, multifamily, and aged care, I would pull out those three as those that are best placed to perform well. But as has been the case for a while now, older offices, some traditional retail premises, those are going to remain more under pressure. So I think 2026 is again shaping up to be a year of more selective opportunities rather than seeing a completely broad-based or widespread recovery.
Thank you very much, Tarrant. I appreciate your time.
Thank you.
Thank you everyone for listening. If you enjoyed this episode, please rate and review it on your favorite podcast platform. It really helps others discover the show. Until our next episode in early 2026, visit cpexecutive.com regularly for the latest news, trend stories, and insights from top real estate executives. And don't forget, you can share your own voice with our readers by clicking the CP Executive Council button at the bottom of our homepage. Till next time.